Welcome to Money Mavericks and Mayhem, the podcast where finance meets audacity in a whirlwind of insight and excitement. Join hosts Adri and Ryan as they bring you closer to the stories of risk takers, rule breakers, and boundary pushers who are reshaping the financial landscape. Perfect for seasoned investors, budding entrepreneurs, or anyone curious about the tumultuous world of money. This is Money Mavericks and Mayhem.
Money Mavericks and Mayhem, where we dive into the lives of financial mavericks, learn invaluable lessons in personal finance, and uncover the scandals that shook the financial world. I'm your host, Ryan Duchak, here with my co-host, Adri Blyer.
Hey, everyone. We've got another exciting episode for you today. We're going to start with an interview about Ben Bernanke, move on to explaining quantitative easing, and then finally wrap up with the story of the cash in the trash incident. And I'm here in studio. Ryan, you're like at the beach or something.
I wish I was at the beach. I've got allergy season's getting the worst of me today. So I decided
I took my Zyrtec this morning.
It's brutal right now.
I don't know if that stuff's in. Yeah, it's been killing me. I've been on I don't like to take medication, just saying that, but it's better than snotting all over yourself.
This is true, and I'm a little worried this is turning into a sinus infection, so I figured I'd stay away from you today and not come into the office.
Not come in, all right. Yeah, you stay where you are. I don't need any.
Yeah, I figured. We can still talk about Ben Bernanke today, the former chairman of the Federal Reserve. Played a crucial role during the 2008 financial crisis. Can you tell us a bit about his background and his contribution to economic policy or the mess that we're in today, as some people argue?
It's a fairly good argument, perhaps. But Ben Bernanke, just to give you kind of an overview, was born in 1953 in Augusta, Georgia. He earned his PhD in economics from MIT. And so, PhD in economics from MIT. Nobody can say, okay, he's not a smart guy, right? I mean, at least from an education standpoint. Later became professor at Princeton University. In 2006, he was appointed chairman of the Federal Reserve by President George W. Bush, that is, succeeding Alan Greenspan, if you remember Greenspan. Bernanke's tenure at the Fed is particularly noted, of course, for his response during the 2008 financial disaster or crisis, whatever we want to call it. It was bad, but that's where he was put on the hot plate and had to try to do his best to figure it out.
I love that I knew exactly who you were talking about when you just said George W. You could have said G Dubs, I think, and I would have known who you were referring to at that moment in time. So what were some of Ben's key actions during 2008? A lot of people don't fully understand what occurred back then, and specifically what Bernanke and the Fed did.
People don't understand it. Well, for one, it was the first time we really ever saw, right? It was kind of an unprecedented measure to stabilize the economy at that point. And there was, if you remember back to that, it was kind of like, well, you only have two choices. You got to try something or just let everything kind of reset. And you're not just talking the United States at that point, you're talking globally. Did they do the right thing? I don't know. I mean, your back's against the wall. What are you supposed to do? But in this case, his most significant action was the introduction of quantitative easing, or QE. We talked about QE a lot back then, which was a policy, I guess, aimed at basically increasing the money supply to stimulate economic activity. It also, at the same time, lowered interest rates to near zero, which we've been at until really recently, and also established emergency lending facilities to provide liquidity to financial institutions like the banks, like the automotive industry, because everything was on a tipping point. And Did he do the right thing? I don't know, and I don't know if we're far enough ahead to really have 2020 vision, because it seems like we're still in what he implemented, and I don't know how we necessarily get out of that. But we talked several episodes ago about fiat currencies and getting off the gold standard. Well, I don't know how you could do what they did while being on the gold standard.
I'm not sure you could have. That's a good point.
I don't think yeah, I mean, I don't think you could have. So when we were talking about, I wish I knew which episode it was to point people back to, but we're talking about, well, why can't we use a hybrid measure to, get off of the gold currency in situations like we're talking about, and then once that's kind of packaged up and behind us, move back to a more of a, I don't want to say stable, but at least something with some underlying value to it, But at the end of the day, the government spent a tremendous amount of money, for really institutions to make sure they didn't fall, brought down interest rates. So we're printing money like we've never seen before, and bringing down interest rates at the same time is pretty much, to sum up, what Bernanke was looking at doing at the time.
It's pretty thought provoking. Of what do you do in this situation? And it's very easy to Monday morning quarterback it and say they shouldn't have done quantitative easing, QE. They should have done something different. But in that moment, basically, we were on the brink of walking into your bank to take out some of your cash and them saying, sorry, we don't have it. What do you do to quell those fears and keep that from happening? I mean, basically what he did was, we were on the brink of a financial collapse. No one had money. What QE did was create access to money, drop interest rates to zero, basically, or as low as possible, and create those lending stations, I'll call them, like the emergency lenders, that were backed by the Fed. Basically, the U.S. government came in and put their neck out and said, we'll take care of it, and we'll print the money, we'll figure it out, and flood the market with money so that basically the dam broke, and we don't have the time to fix the dam at the moment before we run out of water. We're just going to release another dam that flows into that to keep us afloat for the time being, and we'll figure out how to patch up that hole in the meantime. It is basically what they did. And could it have been done better? Where there's downsides, there's pros and cons to everything. But I guess at the end of the day, how effective were the measures that they took? Let's go at it that route and look at it from that standpoint.
Yeah, I mean, if you look at it just on the in that time and place, right? The measures, you would have to probably say, were successful. Again, just looking at that time and place. You've got the automotive industry like GM, they're going down. You've got the banks going down because of primarily because of mortgages. You've got a situation in the streets. I didn't live in Pittsburgh at the time. I was in San Diego, and I remember our community. We lived in a nice community. It became not a war zone, but literally, you had a house with your neighbors with nice nuclear type of family. Now all of a sudden you've got 15 people living there that are all relatives because they've got nowhere to live. You've got people living in their cars outside of your driveway. I mean, that kind of scenario was going on in San Diego. Can't really, but what I understand, it would happen most places. I mean, Pittsburgh is a little bit different because I don't know, the housing market isn't as dramatic typically, or at least back then as it was.
No, Pittsburgh didn't really have the same bubble. So they didn't have the same pop.
And it was really kind of scary for a lot of people. So not only did you have lending to the banks, I don't even know if you want to call it lending, but then kind of the instruction to banks with mortgages to say, hey, okay, instead of bankruptcies and foreclosures, we'll allow short sales, and we'll kind of back you from the short sale perspective to allow people to get out from under that immense debt that they had from mortgages that were, maybe people were, young people coming up, they bought their house in 2006. Again, I'm talking more from my experience in San Diego, and they might have been in a mortgage that was too much. And they had these arm where we had the bubble kind of at the end where you had to pay these big sums. That all kind of came together at the same time. People were really underwater, and they didn't have anywhere to go. So it was a tough time all around. From that standpoint, again, to what we were talking about is, do you do nothing and say, oh, it is what it is, or if you're Ben Bernanke and you got George W. saying fix it. Okay, I got to try to do something. But there were certainly controversial, mixed reviews, all of that. But when it came down to it, many economists believed that without Bernanke's intervention, the recession really could have been much deeper and much longer, going into a depression, possibly. And his policies helped restore confidence in financial markets and also laid the groundwork for subsequent economic recovery. But there's certainly argument to say, have we really recovered economically before 2006? And when I say that, you can say, yeah, well, we have money, from an individual standpoint, perhaps, but from a government standpoint, things really seem to have shifted since that point. When we talk about federal debt, from that point on, federal debt's just exploded.
Mm-hmm.
So I remember talking about it back then, like, okay, we're just kicking the can down the road. I don't know how long that road is, but we're still kicking that same can, and we got 12 packs we're kicking down the road these days, because it's kind of crazy how we just continue to print money. So 2008, roughly 12 years later, 12 years later, things seem fine, but then we've got COVID. Now it's just printing more money. Now we're trying to get ourselves out of that mess. But where are we? I don't even know today. Are we at, I'm pretty sure we're at over 30 trillion in federal debt. I'm sure I could look it up pretty quickly, but that's a lot. And I don't know how you ever get rid of that. We talked about last episode, we were talking about the difference, talking about the fat finger mistake. Mm-hmm. And we're talking about the difference between millions and billions.
What about trillions?
How it's hard to understand. Right, now we're at trillions, and I think it's very difficult for most people to get their head wrapped around what $1 trillion is, let alone 30 trillion.
Yeah.
And it's pretty much, mathematically, it becomes an insurmountable amount of debt.
Yeah, but and this is where the debate always lies. When you're dealing with the unknown, what a lot of people don't realize, there's no good solution. It's one of those situations. Our financial world is so interconnected. A lot of people look at it and have the very simplistic argument of, you bailed out the banks in 2008. They made these risky loans and basically got caught with their pants down. You bailed them out, you shouldn't have. That's the simplistic argument, which in effect I agree. In a free market, that's the way it works. You're in business bank, you made these loans to people who can't pay you back. If they don't pay you back, you lose. It's as simple as that. And the federal government should not have created the QE program to bail you out. And on paper, I agree with that statement. But where that is lost is that is a very laser-focused viewpoint. What you need to also take into consideration is the snowball effect, or the domino effect is probably more appropriate, of what else would have occurred if we allowed the banks to fail at that time. And that's the unknown. To go back and say, was this the right thing to do? You can never know that answer because it was done. We can see the after effect, but we can't see what actually would have occurred if they didn't do it. And where people sometimes get caught up or don't look at or think about is, okay, the Bank of America fails. That's great. Then what happens? Then no one else, and just to go slightly down that rabbit hole, on that individualistic standpoint, for you living out in San Diego, your neighbor, their house, they paid $1 million for their house because of that uptick in real estate. And 2 years later, everyone is out of a house and they can sell it for $500,000. Bank of America loses. But who can actually buy that? Because no banks can loan them money. And then because the banks are all hurting so bad, they can't give small businesses loans to get the inventory that they need. Now those businesses cannot create the products to sell to stay in business. They can't hire the employee. And I'm going deep down into this rabbit hole at this point. But ultimately, you as the employee, you're the next door neighbor, you lose your job because the business you worked at couldn't get a loan because your neighbor couldn't pay their loan, so on and so forth. And now that rabbit hole gets down to our entire economy completely collapses. And we're talking dark ages, basically, when it comes to dollars and trading.
And not to, sorry, I apologize for interrupting. And you were absolutely right. And it doesn't stop there, because now you're talking about global economy. It's not that Bank of America just does business in America.
Exactly.
These banks are doing business all over the world. They're all intertwined, to your point. You look at overnight lending, and now you've got a likely, we don't know, but the likely argument is you have a complete global economic meltdown.
Possibly. And that's where it becomes so hard, because it's possibly, maybe, probably is what it actually is at that state of the game. From what we all understand it to have been, that's the probable outcome. But no one knows, would free markets have prevailed? And okay, Bank of America fails. That's terrible. That's sad. JP Morgan buys Bank of America because JP Morgan didn't make those bad loans. And I'm making this up, by the way. This is pure conjecture of going down that rabbit hole for the flip side of free markets. And another bank, let's not say JP Morgan, just another random bank buys Bank of America out of bankruptcy and stabilizes that economy. That's what a free market is supposed to be. But the fear was everyone was interconnected and intertwined. In that world economy, you're going to have a worldwide collapse of all financial markets. Basically, it's a house of cards. It's all woven together. And if you pull out one card in the bottom, which, like it or not, that's where the banks are. The banks in our economy are the base of that house of cards. And if you pull out 5 of those big, strong, sturdy banks and they all disappear, that whole house of cards can come toppling down. Now, some of the other banks might come in to add support for that. And that was the hope in the concept of free markets. But there's no guarantee that they could have at that time, because there were so many banks in the same situation.
Yeah, absolutely. And you risk, opening yourself up to foreign influence. Okay, the banks start to fail. 1, 2, 3 go down. Oh, okay. Well, is that an opportunity for China? Say, hey, we'll bail you guys out. Wait, we own you now. We're watching a really interesting period of time, because this is maybe, I don't think it's conspiracy minded. It just seems to be what's going on. If you look at capitalism, that we've been, and I love the idea of capitalism, but really only works with a regulatory body who is not sold or bought. You need a regulatory body that it is not playing the game. But we know now our regulatory body, it's become very clear that our regulatory body is not independent. They are owned. Okay, now you have China coming in, perhaps buying these things up. Who owns America? Kind of, because to your point, the banks are the structure that everything else is built on. This becomes a huge problem, and we can't allow that to happen.
And it goes beyond that. America is and I'm not going to look up the stat on it, they're at least in the top 2 lenders in the world. Not Bank of America, but America, the federal government, is one of the largest lenders to other countries as well. If we can't, and we need China to help us and save us, there's a trickle-down effect there as well. And again, there's 2 sides of that argument. If America fails and China needs to bail us out, and then in turn is bailing out another country that we support financially speaking, from a lending standpoint, then one aspect is the whole world economy collapse. The other aspect is China, basically America falls off of its 3-legged stool that we are the most powerful nation in the world, and another country steps up, whether that's China, who knows who it would have been. But that's the counter argument, I guess, of what could have happened in the whole free market capitalistic society. But it's a very deep and possibly dark rabbit hole with all of this. At the end of the day, no one can argue that Bernanke's leadership during this critical period in financial history is absolutely noteworthy. He, again, right, wrong, or indifferent, Bernanke led through that. And you can like him or not. I quite frankly don't care your opinion on him or what they did at that time, whether it was right or wrong. You have to give credit to the fact that it was decisive. And they came in, they figured it out, and they did keep us afloat. That's true leadership to me. It did kick the can. I will agree with that, but it also, we could have been in a very dark situation, very, very dark, very quickly at that point. And it was uncharted territory. Quantitative easing, which we're going to get into in our next segment, that was a term that nobody knew, and a lot of people still don't understand, which is why we're going to discuss it next. That was created in 2008. That was not on the books. This is a tool at our disposal.
Playbook to say, hey, all right, we've got a economic meltdown. Initiate quantitative easing.
They were this play was drawn in the dirt on the sideline. Coach took a knee and said, let's figure this out. This is a prayer. Let's draw this play up real quick and see if it works.
Yeah. No, you're absolutely right. Yeah, let's dive in. Let's take a break, and then let's dive into more about quantitative easing when we get back.
Sounds good.
This episode is brought to you by the Monteverdi Group. In the world of finance, it's not just about managing your wealth, it's about navigating the journey with wisdom and foresight.
The Monteverdi Group stands with the visionaries and the innovators, offering bespoke financial strategies that align with your unique life goals. Whether you're eyeing the markets, planning your retirement oasis, or securing a legacy for generations to come, our team is dedicated to crafting a path that respects your ambitions and values.
So what sets the Monteverdi Group apart? Oh, it's our commitment to personalized service. We understand that every financial journey is unique, and that's why we tailor our approach to fit your individual needs. With a keen eye on the global financial landscape and a deep understanding of our clients, we strive to provide guidance that not only meets but exceeds expectations.
So come and join us at the Monteverdi Group, where your financial aspirations meet our expertise. We're here to navigate the complexities of wealth management together, ensuring that every step taken is a step towards achieving your dreams.
So discover a partnership that values your vision. Visit monteverdigroup.com to learn more about how we can support your financial journey. The Monteverdi Group, where your financial future is in dedicated hands.
That's MONTEV as in Victor, ERDE group.com.
All right, we're back. We were talking about Ben Bernanke, quantitative easing, what happened in 2008, what would have happened if they didn't do that. And that's all certainly speculation, but interesting thought process, I think. But so Ryan, quantitative easing, or as we said, it also known as QE, is now a term we hear in discussions about central banking. Can you further explain what it is and how quantitative easing works?
Quantitative easing, it's a monetary policy tool that's now used by central banks to stimulate the economy when standard monetary policy becomes ineffective. This typically happens when interest rates are already near zero. They really can't be lowered further to encourage borrowing and or investment. Does that make sense?
Yeah, it does. I mean, you think about back then from a housing perspective, at least, or really any lending. I mean, it was pretty low. I don't know if it was as low as after it was quantitative easing. I don't remember 2007, but I do remember the mortgages, car loans were all pretty aggressive, pretty low. I mean, they were probably, I don't remember the mortgage rates, but maybe under 5% probably at that time.
Yeah.
And they did go down more, but you don't, to your point, you don't have that far to go till you get to negative interest rates, where you don't want to go to negative interest rates. So
That's bad.
no,
Negative interest rates are bad.
That's bad. Yeah. They are very bad. I don't want that. So yeah, no, that makes sense. How does QE work?
And that's where it gets confusing. So in a QE program, the central bank purchases long-term securities such as government bonds and then mortgage-backed securities from the open market. By doing this, the central bank increases the monetary supply and lowers interest rates on those securities, which then in turn encourages banks to lend more and businesses to invest and spend, with the goal of boosting economic activity and preventing deflation. So basically, what the central bank is doing, and this is where people get very confused. I won't share my personal opinions on this, but when people think of the central bank or the Federal Reserve, they think the government. And that's true in effect. They're a subsect of the government. They're a government entity, but you have the Treasury, which is selling the bonds, selling the government bonds. That is not the Federal Reserve per se. We'll argue there's Chinese walls between them. Basically, the Treasury issues a government bond, and normally once that's issued, that's sold on the open market, bought and sold between private parties, I'll say, investors at that point. When you're doing QE, the Federal Reserve or the central bank says, we are going to buy them on the open market, which pushes yields down. They're basically flooding the market with money to buy up all these bonds. And traditionally, it's the banks who have a lot of the benefit from that purchase. The banks get a ton of money, interest rates are low. They are incentivized to lend out that money instead of taking that money and buying more bonds. So when the bank lends money, if I'm a small business borrowing that, or a large business, it quite frankly doesn't matter. I borrow more money from the bank because I'm getting a better interest rate, and now they have it and they're approving more loans. I'm going to go start a business and then, or buy a house, whatever it may be. When I do that, that boosts economic activity. When I start a business, what I'm doing, I'm paying contractors to build out my business. And let's say I'm building a location from dirt up. Now I'm paying all those contractors to build my location. I'm buying office space, supplies and things of the like. That all stimulates the economy. So the premise of how QE works is basically flood the market with money to get people to spend money to stabilize our economy in general and keep people spending, instead of having all of these foreclosures, no business lending, and everyone goes to a standstill basically, or backwards.
Right. Would you consider that market manipulation in a pure sense? That was one of the questions I had for you, but as you were talking, I'm like, you're doing what you can in market manipulation.
So I wouldn't use the term manipulation purely from this standpoint as that's a negative connotation. It does manipulate the general economic market, but that's the Federal Reserve's job. Isn't my reverse argument to you, so to say, or question would be, isn't adjusting interest rates market manipulation as well? That's the same thing. Sure. This is their job, is to, in theory, manipulate our economy. And that's why I don't like that term manipulate, because it sounds negative.
Right.
But their job is to manage it, whether that's stimulating it or destimulating it. I don't know if that's a word. Slowing it down, one of the two. In their traditional standard monetary policy measures that they can do are using interest rates to do that. The higher the interest rate is, the less lending you have. People aren't borrowing as much. You're cooling off the economy. The lower interest rates are, the more people are borrowing. You're stimulating the economy. If those options aren't working, that's where something like quantitative easing comes in an effort to stimulate the economy. Yes, it is market manipulation in your plain cut question, but that's what they're supposed to be doing as well.
Yeah, gotcha. Okay, what do you think the potential? We've kind of touched on the risks previously, but risks and also then criticisms of quantitative easing.
Yes, and that's where that manipulation question comes in, because one of the main criticisms of QE is it can lead to asset bubbles. You're creating, especially in 2008, you had a real estate bubble burst, and then you flooded the market. And people's argument is this influx of liquidity can drive up prices in other markets, creating another asset bubble. And this is to kind of hit on your kicking the can argument, that is a lot of the argument. You didn't solve anything. You put a Band-Aid over a bullet wound, basically, and said, the example I gave earlier of the dam, there's a leak in the dam, water's flowing out, and instead of fixing that leak, you just dumped more, you just turned on the spigot from another dam to flow into that to keep it going. But there's further implications to that, and by doing that, you can create another bubble. One of the biggest, and this is probably my biggest criticism of it, is the risk of long-term inflation. If you're not managing that increased money supply, and in attempting to pull that out of the economy at some time, which is, trust me, I'm not saying I know how to do that appropriately or the best way to go about that and when to do it. But if you don't do that correctly, you're going to create wild inflation because you're just flooding the market with money. And that's one of the leading causes of long-term inflation. That's the argument right now. Everyone is talking about the inflation that we're living with right now, which is bad. It's not a good thing. But a lot of this is based on COVID. And when COVID happened, you had everything change and businesses were shut down. And it's a similar argument of you had to do something, but you threw money at the problem, basically, dumped a bunch of money into the economy, which then people started spending that money. And therefore, that creates inflation. And there's multiple aspects. It's not as simple as that, especially with COVID and the whole supply chain side and businesses being stopped. There's more to it, but in its most simplistic form, that's the risk. Is when you flood an economy with additional money, you're going to create inflation or hyperinflation, and you have to manage that properly.
And
Go ahead.
Go ahead. I was just going to piggyback on that and say that something that it seems to be people get upset with. If we go back to just COVID, not 2008, and shutting down businesses, but yet letting larger businesses stay open that were deemed necessary. But yet, if you just say Lowe's, for example, but maybe I own another hardware store, but I'm not as big as Lowe's, or I'm just a local hardware store owner. Okay, well, no, you can't do business, but Lowe's can, and they're more important than you, which leaves a bad taste in people's mouths because at the end of the day, who's benefiting most? Yeah, well, people got $4,000 or a month or whatever people got in COVID. And okay, they go to spend the money. Well, I can't spend the money on my neighbor's shop. I want to do some home repairs while we're stuck inside. Bob down the road owns a hardware store. I can't buy from him, but yet I got to go line the pockets of the corporate board or the CEO from Lowe's. Or whatever. I mean, I was just picking on Lowe's. You could go to any. So I think that people do get frustrated, the majority of the population, saying, okay, thanks for helping us, but at the end of the day, we're just giving the money back to the most wealthy of the wealthy.
Well, ironically, that was what I was about to bring up. That was the additional risk or criticism is it can disproportionately benefit the wealthy in two different forms, actually. The form you mentioned of Lowe's, Home Depot, whoever, it doesn't matter who it was, but whoever was allowed to stay open in that situation were being benefited. And those were typically the big wealthy companies. They were benefiting where Bob's Corner hardware store was forced to shut down. Now, Bob got some PPP money. He was able to survive in that scenario, but when Bob comes to reopen, everyone's already a loyal Lowe's or Home Depot customer at that point, and figured that out and got accustomed to that. Are people going back to Bob's Corner store, or what happens to Bob in the focus there on Lowe's and Home Depot? That's a big issue, quote unquote, with QE. But also, when you're potentially creating additional asset bubbles or in the financial markets, traditionally speaking, who benefits when values rise artificially, maybe I'll say? Who benefits the most? When the Federal Reserve is buying up all these government bonds, traditionally speaking, the people who own government bonds are already the wealthy. They're the banks, they're the
Yes.
institutions that are looking for very low risk, safe investments because they have the money already. Though when the Federal Reserve is flooding money into that market and buying those treasury bonds up from Bank of America, what they're doing when they're flooding that money, it goes back to supply and demand. The supply staying the same, the demand skyrockets, so the price goes up, and that's what brings those yields down. And why it incentivizes people to borrow money instead of invest that in the bonds. The yields are low. It's a good thing from stimulating the economy, but the person who won, they bought a bond at $100 or $1,000 per bond. They sold it at $110. They benefited from that, and that's traditionally the wealthy, the big companies, the big, like, the rich, the 1%, however you want to term it. Those are who benefited disproportionately to Bob Sole, small one hardware store owner who's just trying to make his mark and do the right thing. That's who loses, and the big corporations are who win.
Yeah, that makes. I mean, it's sad to watch, but again, as we talked about, it's like, well, what do you do? Do you make the move? Because obviously, there are risks that we've been talking about with quantitative easing, but despite that, it has still been shown to be a critical tool for central banks in times of economic distress, as we're talking about. I don't know that we've really fully grasped or seen the end of okay, what are those effects? I don't know that we will, because it seems now that we're kind of stuck in, okay, we just keep printing more money. And hope, it just seems to me that at some point this all has to come due, but things have got so complex that maybe it doesn't. It's really
thing is,
anymore.
We have, this is what I love, and this might be my favorite analogy that I can give. We have all of these very smart people, leading economists and authors, and writing all these theories. Where we are as in economic theory and in economic management, I'll say, is just like parenting. We're figuring it out as we go. There's thoughts and ideas and theories of how to parent your child, but every single parent is figuring it out day by day. They don't know what they're doing. And that's in effect the situation we're in with quantitative easing and things like that. We're not certain how one move will impact another. It's all interconnected, and you have to think of it. When you're parenting your child, it's very simple just to say no. But what are the future implications of that? And what am I saying no to? And is there a different way to do it? So on and so forth. It's the same thing with monetary supply and economic management. We get into a situation of economic distress, and something needs to be done. We have to parent the economy. How do we want to go about doing it? And in this situation, the Federal Reserve was mom and dad getting together and saying, what are we going to do to keep this from turning into a major meltdown? Do we give in and just give the candy to the baby at 9 o'clock at night? Or do we stand firm and let the baby keep screaming and see what happens and hope it doesn't boil down into something worse? And there's no true right answer. There's ideas, there's thoughts, there's concepts, but until you run through it, you don't fully know what's going to happen.
No, and to your analogy, you could say, "Oh, I'm a great parent," or "My wife's a great parent," or whatever. "My partner's a great parent," but it's not up to you.
Yep.
Right? You can think you've done the right thing, but you know what? You don't know that you're a good parent or a terrible parent until the kids are now grown and adults and 20s or 30s, and they can look back and say, okay, it's their decision whether you were a good parent or not. It's not yours.
Was 2008 and QE a good move? I'll tell you in another 10 years. Is the answer.
Or maybe we'll figure it out before I die.
Yeah, you're absolutely spot on with that. Only time can tell. We don't know. It's the decision that was made. There's good things that came of it. There's bad things that came of it. It's what was right. And there's the constant debate of that with, you look at what's going on right now, and who do you bail out? Who do you make it easier for? The wealthy or the middle class or the lower class? There's no right answer. There really isn't, in my opinion. I can make the arguments on all sides. If you make it easier on the business owner and give them more money, the theory is they're going to hire more people and help them trickle down to help the lower class. The counter argument to that is they're just going to put it in their pocket and the rich get richer. And they're going to keep sticking it to the little guy, which might be true. It's situationally specific, I would argue, depending on the person. And the hard thing is, when you're making economic policy decisions or just general government policy decisions, you can't make everyone happy with everything. There's always a downside. There is no magic golden ticket that has all upside and no downside where no one has a negative implication from it. So
you have 330 million children. I got 2 children, and trying to make both of those happy at the same time.
Yeah, it's impossible. You can't keep 2 happy, and that's spot on. How do you make everybody happy? And there's no way. And everyone has their thoughts and ideas, and you should do this and you shouldn't do this. And it's real easy to stand and say this is bad. And that's kind of my viewpoint with quantitative easing. It's very easy for me to criticize. What would have been better? What should we have done differently? And that's a much harder
thing. What would have happened if we did?
Exactly.
Yeah. I mean, nobody knows.
That's impossible to answer.
Yeah, absolutely. Well, thanks, Ryan, for breaking that down and explaining more about quantitative easing, how that worked. I think we could, everybody would have their opinion on it. If anybody's listening and want to, drop us a line. Tell us what you think about quantitative easing and what your perspective is, because it's always great to hear everybody's perspective. But let's take a break, and then when we come back, we'll talk about the cash in the trash incident.
Oh, that's a good one.
Love that.
Struggling to wake up refreshed to tackle your busy day? Introduce Nolapelli to your bedtime routine. Their innovative bedding and sleep masks work in sync with your body for deeper, more restorative sleep. Made right here in the USA from advanced performance fabrics, Nolapelli products balance moisture and regulate temperature so you wake up looking and feeling ready to conquer whatever the day throws at you. Invest in better sleep and better mornings with Nolapelli. Use code MONEY15 for 15% off your first purchase, because the path to success starts with waking up on the right side of the bed. Nolapelli is not affiliated with LPL Financial or the Monteverdi Group.
All right, Adri, we're back, and the cash in the trash incident is peculiar, I'd say, but fascinating at the same time. Can you walk us through what happened with the cash in the trash?
Yeah. We're going to go back to 2011 in Ashland, Oregon, or Oregon, whatever. A local man, he was sorting through his deceased relative's belongings, because you got to go through the estate, figure out what's what. Accidentally threw away a box containing $23,000 in cash. Oops. Open the box, man. It's like that movie with Brad Pitt. What was that? Seven? What's in the box? Anyway, $23,000 in cash. So long story short, the money ended up in a landfill, leading to a frantic and somewhat unusual recovery effort.
What you got to elaborate on that. How did the community? What was unusual about it?
The local waste management company, and then also community members, jumped into action. $23,000. They started to sift through tons of garbage at the landfill. I don't know. I mean, $23,000 is a lot, but like when you go up to a landfill and you're like, oh, we got to find $23,000. How what goes through your mind? Like, okay, 23 grand.
But landfills are big. And like, am I getting a piece of this if I find it? So like, what's my incentive? Am I doing it to be neighborly and help someone who accidentally threw away 23,000?
First one that gets the cash.
Or yeah, finders keepers.
Yeah. So so obviously they were trying to find, and it only took them hours, but they somehow, who knows, they did recover nearly all the money, which is, there's a show, shoot, and I just can't, it's called, I don't think it's on anymore. It was about, come on now, the Silicon Valley. It was called Silicon Valley.
That was a great movie, or a great show.
Yeah, it was a great show. It was fun. But there was one scene in there where one of the tech entrepreneurs had like $1 billion on his hard drive. It's some idea or algorithm that was worth $1 billion. Somehow it got thrown away. And he hired 10,000 people digging through the landfills to try to find this billion, which at some point you're like, holy, yeah, it's $1 billion is one.
I'll go to Amsterdam.
In Oregon, I've never been there. I don't know how big that landfill is, but still, you go, okay, do you even participate for 23,000? I mean, and again, not to say 23,000 isn't a lot of money, but the likelihood that you find it and digging through trash, I don't know how long I'm going to last. But anyway, the cash in the, so it's just, we talk about estate planning, and this is actually kind of timely because I got to go out and look at my mom's estate. My mom passed away last year, and so it's going through her house. And like this lady wonderful woman, had stuff everywhere from generations, like antique stuff that I don't know what to do with. But she's going, okay, I have to open every single box, everything, every little, it's knickknacks and stuff everywhere. Those Russian nesting dolls.
Oh yeah.
You never know. You could find like a golden. I don't know. Now it's giving me the, Ryan, why do we have to talk about this?
Yeah, I mean, it's heartwarming in one aspect when I think about the cash and the trash aspect, that the community got together and helped search for this money. But it's also cautionary when you think of estate planning. You have to have someone, I don't care who that is, someone or something that, to me, it's very important, that provides a roadmap of where everything is, whether it's probably not smart to keep $23,000 of cash in a box, unless it's a safety deposit box type of thing. But just regardless of what your estate plan is, someone needs to be aware of it. It's one of the biggest things we do with clients of what happens if I shouldn't say, I was about to say we play a game with our clients. It's not a fun game. We play a scenario out with our clients of what happens if you don't make it home tomorrow. Let's go through that. What happens? And then we say, okay, now what if your spouse is well? And it's to get the person or couples to start thinking about it of, well, in a lot of times in relationships, you have one spouse that is the primary manager of the finances, so to say, and the other spouse does not. So what happens if Adri, you're the person who handles all of your family's finances? What happens if you don't come home tomorrow? Is your wife, does she know how to log into the online banking? Or if your wife's the one who manages it, on the flip side, how do you go through and get that? And then take it a step further, what happens if both of you don't come home? It's very simple to cover the big things. Like, well, you have 2 kids. If we don't come home, then this person is already knows that they're going to take care of the kids. Okay, how are they going to do that? And with what money are they stepping up and paying for college, not paying for college, whatever the situation is, and it's what are your wishes? And then who knows, when you go further into this beyond the wishes, who knows where things are? If you're a person who has a box of cash in a shoebox in your closet, that's full of cash, your wife probably knows that that's full of cash. If I'm the executor of your estate, or I'm the one who's going through it to clear everything out, do I know that that's there? Or is there a document somewhere that tells me that that is there, that I can go through it and find that out, instead of just saying, this is an old box, I'm just going to throw it away? I mean, I should look through it instead of just randomly throwing out shoe boxes that are heavy, but it's a big task. So things can get missed. You need to have that roadmap. And again, you don't have to go tell everybody every inner workings of your finances, but have a roadmap somewhere, in an envelope, in a safety deposit box, something somewhere, somehow, that guides that person or those people through how to go through stuff. We have some technology tools that we use a lot, where our clients tell their executors or their loved ones, basically, if something happens, call Ryan and Adri. Here's their information. If something happens to us, call them. Obviously, we need to be supplied with a death certificate and know that something actually happened. But once we get that trigger, we have websites, we have files for clients that have everything broken down, so we can hold their hand through it. And we're not saying you have to use us for that necessarily. You can do it on your own. You can leave a letter in a fireproof safe. You can heck, you want to get old school with it, do a letter that's got a wax stamp on it that you mail to your loved ones, that's open in the event of emergency only type of thing. Whatever it is, having that plan in place is vastly important. And at the end of the day, the best advice is, don't keep $23,000 in a box randomly in your house. That's not good estate planning.
It definitely is. And I got a couple of things because there's multiple levels of estate planning, and it's very important. I've been talking about this more and more, especially dealing with my mom's estate, because it should have been all pretty much buttoned up from the conversations we had. Now, she had dementia for a long time, so communication for the last decade wasn't available, but previous seemed like the whole estate was taken care of. Well, now here we are, and it's kind of a mess. But there's estate planning that's like for wealthy people, and a lot of people think that, oh, I don't have the money for estate planning. That's a different type of estate planning. Typically, when we're talking about wealthy people, it's wealth transfer, it's dynasty type trusts, and then also tax mitigation.
Mhm.
But for a lot of, like, even young people, I just had this conversation last week, talking to some young folks who are two children, one's 3 and one's 8. They do fine, just normal type of income. And he was asking about life insurance. And we started talking about life insurance. He's like, well, I don't know if I need. Hear that the like term life, and we have had this conversation before. This is not a life insurance episode, but it's a kind of, I heard that's kind of a waste of money. Okay, maybe, but for where you are in life right now, to your question earlier, what happens if? What happens if you and your wife don't make it home tomorrow? Where are the kids going to go? Well, we don't really have, I don't know. Well, okay, we'll say, I don't have a will. Okay. Trusts, you can get these done for reasonably inexpensive. I'm not saying go to I doubt you can get them for $99. I would never recommend somebody go to the cheapest, on the penny ads or whatever. But, believe for a normal set of wills, trusts, powers of attorney. We're not attorneys. We don't actually draft the documents, but we help formulate how these things should be worded, perhaps. Is, I don't know, what do you, 15 to probably under $2,000.
Yeah, it depends on the complexity. For very simplistic, I'd say 15 is your high end for a very simplistic.
Just simplistic, basic stuff. But then the life insurance to say, okay, if you don't, and for conversation, say your sister's going to take care of the people. Okay, well, what does she do? Is she independently wealthy and she doesn't care? Well, no, okay. Well, here, for pennies, basically, here's life insurance. You don't need it for the rest of your life. You just need it till the kids are old enough to be on their own. If something happens to you, your sister gets the money in trust. The trust, you dictate what the trust is allowed to spend. So it's not just these kids getting $1 million or whatever the number is. You can dictate all of this after if, God forbid, that you pass. Well, the rules are still in place because you want your parent or your kids to be raised the way you want them raised. You may not want them to have, they turn 18 and they each get $500,000. Say, oh no, I want them to have enough to pay for school, and then the rest, just for example, they can't touch till they're 30, and maybe they get a third of it when they're 30 and more. You can make up all the rules you want.
It's control of your wishes at the end of the day.
Exactly.
In having, ironically, my sisters who would take our kids if something happens to both of us, and I trust my sister implicitly, I trust my brother-in-law. It's not a question of that, but it's also, we have not gone through, and they know a lot about our parenting style and us as people, but they're going to be making assumptions at certain things. Do we plan on paying for college? We're paying for it, or do we plan on making our kids take loans out and then paying for it? Having that control down and explaining that inside of your will to, this is what we want. And you can get as controlling as you want or as loose as you want. In my will, I can say, when my kid is 16 or of the age to get their driver's license, buy them a reasonable car. Well, what is reasonable? To me, reasonable is one thing. To somebody else, reasonable is another. And I know this isn't your case, but Adri, you might say, well, a Range Rover is incredibly reasonable because of the safety standards. Whereas I say a Honda Civic is reasonable because the kid's going to drive it into how many garages and walls and other cars. So, and they're not going to take care of it. I'm not buying a Range Rover for my 16-year-old. Reasonable to me is a used Honda Accord. And again, to each his own. I don't care what your preference is, but making sure that that future caregiver knows what your intentions are. Because just saying, here's my life insurance money, here's the money I have amassed, and here's my kids, best of luck to you. You can do that. That's up to you if that's your preference. Or if you want to say, no, we want our kids to be going to private schools. We want this, we want that. You can have that control.
Yes. And now one other thing I wanted to say is for people that are maybe a little bit older, that are thinking about their legacy. And it's not that you have to have a tremendous amount of money. I mean, obviously, if you don't have any money, you don't need any estate planning because you don't have anything to really plan for. I shouldn't say any, but if you have something, even if you don't think it's a lot, do basic estate planning for your heirs for your kids if that's what you wanted to do. Because I know both of the kids they're perfect, they're wonderful. But listen, we've seen it all the time. I know you've seen it all the time. When there's money involved, terrible things happen.
Not only just money, it's money and things. So the worst part, money, to me, the money is the easy thing. The things are the hard thing. I am one of three. You are one of two. With your mother's estate, I'll throw you under the bus on this one, or use you as my example. You mentioned the Russian, what are they called, Fabergé eggs, or the Russian nesting dolls. Yeah. Those things. Yeah. Those have value to them, whether it's financial or sentimental, does not matter. Those have a value. If there is one, and you, for whatever reason, you want that to remember your mom used to play with you with it, whatever, I don't care. And your sister has the same viewpoint. Are you two fighting over it? And then who gets to keep the one doll that is the best memory both of us have of our mom? And I'm going down the rabbit hole, but now, do you and your sister not speak to each other because you were the jerk that stole her doll from mom and hardlined it and refused to let your sister have it, or vice versa? Again, it doesn't matter. Do you two now hate each other and not speak all over a doll because your mom did not specify either in her will or sell it while she was living to avoid those arguments or have those conversations beforehand? No one likes talking about theft. It's not fun. But if you're older, have a conversation with your kids. Is there anything of mine that you have a burning desire to have? While you're living, you be the mediator. Again, it's not fun, but talk to your kids. If my dad's got this old scale that it's probably worth a couple $1,000. He asked me a couple years ago if I wanted that. He was going through this process of his estate planning, and that was one of his like antique items. And he said, "Do you have any interest in taking this?" And I said, "Look, I like it. I would take it if you gave it to me. If somebody else wants it, I'm not in love with it and I need it. If you want to give it to my brother or sister, that's fine. If you want to sell it and convert it to money and then split that 3 ways, that's fine too." I was indifferent on that one, but you have to have those conversations and figure that out, so that what if me, my brother and sister, all three wanted that scale? Are we now sharing custody of my dad's scale? No, that's not happening. But if my sister ends up getting it because she's the oldest and she was the executrix of the estate, she decided she gets to keep it. Do I now have a chip on my shoulder against her? And are me and my sister negotiating when we're discussing my dad's estate of, well, you can have the scale, but I get an extra $5,000. Come on.
Yeah.
It'd be much better if dad just handles that beforehand.
Yeah, no, it can, definitely get it to handle beforehand, because you don't really want it to be a mess. You probably don't want to be a mess for your kids. I mean, if you're masochistic in some ways and like, yeah, let's torture these kids. They tortured me for 20 years. Let's get them. But otherwise, just get it handled. I know it sucks, to your point. Nobody wants to talk about it, but it makes everything much more defined and easy to move on. Because now if you don't, you could spend months, years trying to go through this stuff.
Quickly, I know we're running long, but and this is a higher value. My sister's neighbor, so my sister lives in Florida. Her neighbor had 2 kids, and apparently the guy was very wealthy. It was a big estate. The kids he did not make any decisions in his will about his house. The 2 kids could not agree on what to do with the house. One kid wanted to keep it. The other kid wanted to sell it. And based on the will, and I don't know the full intricacies of it, but they both had to make a unanimous decision. The house is in ruins. There's I think it's a Rolls Royce, like a 1970 Rolls Royce, that has been sitting under the carport for probably 20 years, rotting. The house is completely fallen apart, and it's a teardown now, all because they could not agree and got so spiteful with each other. And again, I don't know the full details. It's probably a $2-3 million home that is now worth the land probably only because they could not agree and hated each other so much throughout the process that they just let it get destroyed. And how much money and pain and aggravation did that cause when the guy could have easily in his will stated that you're forced to sell it, or whatever stipulations you want to put in there so that situations like this do not occur.
Yep. You'll have to agree to sell it, or if one of them wants to buy it, they have the first right to buy. Yep. But otherwise it gets sold. I mean, things are pretty easy once you get them down on paper, and some people get overwhelmed because then they think they have to, every penny they have to.
Yeah, you don't have to go through everything.
All my tools. Who wants my Phillips screwdriver? Like, no, you don't have to go that deep. But the major things, just get them down on paper, because the infighting, and I can't stress it enough and say how often we see this kind of stuff where relationships are ruined. Siblings relationships are ruined. It's just because of stuff and money. It's silly, but that's the way we live today. If you want your sibling or your heirs and your children, whomever to make it easy, even though you think that they're both always on point, don't assume that. Again, when it comes to money and things, to Ryan's point, it gets weird.
Communicate.
Just put it down.
Talk to your kids. Yeah. Is there anything you want? That's how you find out. The answer might be that Phillips head screwdriver. It might be, hey, I have this memory of turning my first wrench with Dad, and that is near and dear to my heart and very sentimental value to me. You don't know as the parent. Talk to your kids, and it's as simple as that question. Is there anything that you particularly want? Just leave it at that. They'll tell you if there's anything specific. And if there's not, they'll tell you that. And that's how I am. My answer was, hey, there's nothing particularly, a couple pictures of us together I would like. But I mean, your scale, I don't look at that and necessarily think of you, but I'm indifferent when it comes to that stuff. But
yeah, but talk about it. To your point, talk about it. Yeah. I think it's a good ending point. I think that wraps up today's episode of Money Mavericks and Mayhem. To all of you out there, we hope you enjoyed this episode and the dive into the life of Ben Bernanke, learned valuable insights about quantitative easing. And briefly, we kind of got off track, but we talked about the cash in the trash incident. Just get your estate planning done. That's what we're saying. Don't forget to subscribe and rate and review our show, please. That goes a long way to helping more people listen. Join us next time for more fascinating stories and lessons. And until then, stay savvy and stay safe and have fun.
Take care, everyone.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to effect some of the strategies. Investing involves risks including possible loss of principal. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC.